Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good evening and welcome. Special day today after a simulcast in Delhi and Bangalore. Today Punekars are joining us, so we can welcome them to our FOF session. So it's the first of hopefully many sessions in Pune to come. Announcement about the forthcoming sessions. So the dates for December and January are on the screen. Both are Thursdays, December 19th and January 23rd. So please make a note of that. The talk today is very unlike the Financial Opportunities Forum talks that we have had in the past. I can't recollect anything which is vaguely similar to the past talks. In fact, this is more like a yin and yang. So all along we have been talking about value investing, long-term investing, low churn, quality business, this, that. Today we'll be talking about trading of all things, right? Interesting. So I guess by now people would be bored about the same broken record of long term. So today we'll talk about short term. But it's not any kind of trading. It's a special kind of training, and I'll get into the reason why we are talking about it. So it's not like the Pope has suddenly turned atheist or something like that. It's not that we are discarding value investing and going to some other field in the future. I'll tell you the reasons why we are looking at such a thing. So who does not know who this person is? Almost everyone in this room will recognize the photograph. It's obviously Warren Buffett. But how many people recognize this person? Show of hands. Yeah, 2 or 3. So about 2% of the audience. We'll talk about this person as we go along. This person has had a track record which arguably is far, far better than what Buffett has achieved. But most people don't know about him, or even I did not know about him till probably a few months back. And it's recently that I've got to know about, or I had heard about this guy's name vaguely, but I did not know what all he and his organization do. And it's only recently that I got to know more about them. A book on this guy has been published called The Man Who Solved the Market. Interesting book. So We'll be talking about a little bit of that book, but the today's talk is more than just talking about that book. So unless you have been living under a rock, you would have heard about things like artificial intelligence and machine learning. Somewhere or the other, you would have come across these terms in the media. We have heard about self-driving cars. We have heard about how Google's artificial intelligence computers learned to play the game Go and beat the world champion. So far, computers were not able to beat humans at that endeavor because the game was extremely complex and writing a program was very, very difficult. Again, a few months after that, what Google did is it put computers to play against themselves. They did not program the computer, but the computer self-learned the game of chess. And in some time, the computer started beating the strongest programs that humans had written over many, many years and decades. So this is the kind of progress that is happening in the field of machine learning. Jim Simons will talk about. Again, last year another book came out, A Man for All Markets, written by Ed Thorp, recounting his journey into the field of trading, stroke, not so much investing, but trading or gambling and things like that, probabilities and stuff like that, the quant world. So we would have come across terminologies like quant investing, factor-based investing, ETFs, high frequency trading. There was a book called Flash Boys, written by Michael Lewis. So all of us have vaguely heard about these terminologies, but we are not clear as to what it is. And till some time back, my blind reaction to all of these things was that it's not for me. I am a long-term value investor, quality purchases. All these guys are short-term traders. Finally, high churn results in high brokerage transaction costs. Hardly anyone makes money. It's all noise, or sometimes it's high risk. So we have all probably come across long-term capital management, which was a company formed by Nobel Prize winners. And they went famously bankrupt in the late 90s. They blew up spectacularly. So sometimes if the returns are very high in the short run, it's probably because of extremely high risk. So somewhere down the line, they go bankrupt. Also, you would have heard about this bet that Warren Buffett had with a hedge fund of funds, where Buffett said, I'll put my money in a, let's say, Vanguard index fund, which does nothing, no equity research, nothing, plain buying the index stocks. And the other person had a choice of selecting, let's say, 10 best hedge funds. And Buffett said, index fund will do better than the hedge funds. And it turned out that Buffett was right. He actually won the bet after passage of a certain length of time. So my reaction was, all this is flash in the pan kind of thing. Sounds nice in theory, but practically does not work. That was until some time back. This is the track record of the person whose photograph we saw, Jim Simons. Over 30 years, he's had annual returns of 66% in dollar terms. And you look at the after fees. So on an average, he's made 27% fees. So bulk of the returns he's taking away for himself. But still, the net returns for clients have been 39% over 30 years. Buffett doesn't have this kind of record, right? Is this impressive? Seems impressive, right? But what is the first reaction? Or what is the question that comes in the mind? Is he taking too much risk? Is he going to blow up? That is one question. The other question could be, is he a fraud? So if something sounds too good to be true, usually it is. Usually, so Bernie Madoff also had a spectacular track record till it was found that he's running a Ponzi scheme. Again, in 30 years, he had just 1 year where the fund lost money. And that too was minus 4%. And that also was in the beginning period, within the first 2 years. If you exclude the first 2 years from his 30-year track record, the minimum annual return net to clients has been 21%. Minimum. And look at the returns in 2008, when the world was supposedly coming to an end, when everyone was suffering huge losses. His clients made 82% return in 2008. He's not had a single down year after 1989. So if you say that minimum return in a year is 21%, then even debt money can be allocated here, right? So all your equity money can be put in and debt money can also be put in. Is there a downside in this strategy, or what is it that this guy is doing? So this is the other impressive part. Apart from the absolute numbers, the fact that even in catastrophic years, he does not lose money is again something which would arouse curiosity, if nothing else. So whether you agree with him, disagree with him, these numbers warrant some amount of scrutiny as to what is it that this guy is supposedly doing. So this is what the table of returns looks like. So I've given the gist on this slide, but yeah, so 55, 39, 33, 70, 38, 21, this kind of thing. So no down years, positive numbers vary somewhat. That's the kind of returns. Average return of 39% net of fees, before fees 66%. So this is the kind of returns that the Medallion Fund has generated over the years. So the first question which arises is this guy another Bernard Madoff? So he's showing spectacular returns to raise more money from clients and taking the new money and paying older clients. Is that the case? The answer to my mind is unequivocally no. And I'll tell you the reason why. Because a few years back, he paid off all the clients. He says, I don't want any external clients. I'll only manage money for myself and my staff. So obviously when you have paid off all the clients, then that is real money. You can't have accounting profits to pay real money. So he's paid real money of this kind to clients. So is he a Bernie Madoff? No. Answer. Is this a future long-term capital management? So is this an organization which is taking very, very high risks and which will blow up in the future? So one thing is that obviously he has a 30-year track record and he hasn't blown up in 30 years. So he must be doing something right. That does not preclude the fact that there would be some hidden risk and maybe he could blow up in the future. So like Nassim Taleb's turkey, where the owner feeds the turkey and one Thanksgiving or whatever, he cuts the turkey. So will it blow up in the future? I don't know whether yes or no, especially because of the fact that he does not talk about his methods so much. And there is a certain amount of leverage built in the strategies that he adopts. So this was the background till here as to why I got curious about what people like Jim Simons are doing. Not just him, other people in the world who are called quants. The book is interesting. It gives anecdotes. It gives a glimpse into what he does. It gives his life story. but does not explain the methods. So it's not like the tons of books written on Warren Buffett where he explains that you should buy companies with moat, you should buy companies with low debt, you should buy things with margin of safety. So Buffett is very open about his methods. He has this annual meeting where he calls everyone. Jim Simons is not in that category. So he's a very secretive person. The reason why we haven't heard about him is because he does not want to be heard about. He was very unhappy that this book was written in the first place. So while we know the fact that he's extremely successful and that he's done well for himself, we have some glimpse into his methods, but we don't know for sure exactly how he does it. So we'll just take a broad overview of what all things are possible, what are the risks that could be there, and what all can be learnt by even long-term investors from some of the quants. So as I mentioned, he is secretive. He does not accept outside money. The book makes very interesting reading. So people who are interested can pick up the book and read it for curiosity. But it is not a how-to-do kind of book. By reading the book, you will not start generating 66% return or 56 or 46 or even 26. It does not tell you how to do it. There is an element of leverage. So the book alludes to the fact that if the organization or the hedge fund owns 1 rupee or $1, they would have exposure of $15 to $20 in the market. So there is a 15 to 1 or 20 to 1 leverage. Now, they are aware that leverage could come with risk. So what they do is, they do long short, they hedge, they use options to limit the downside to them, all of that. But again, given that all the details are not there, we don't know what kind of risk they carry. But they use leverage and they use options and offsetting trades. The other thing that we know is they trade in a variety of asset classes. They trade currencies, bonds, commodities, and recently even equities. Their earliest successes were in non-equity kind of instruments. In recent years, they have been successful even in equities. Another very, very interesting part is that the company, Renaissance Technologies, which runs this Medallion Fund, they don't employ CFAs, they don't employ chartered accountants, they don't apply MBAs, none of these. In fact, it's almost like a disqualification. They don't recruit from other, or they were, for a very long time, they were not recruiting from other Wall Street firms. People who are recruited are math and stats professionals, are computer programmers, are physicists, or people who have been working in the early stage of machine learning, natural language processing, or physicists and things like that. So science and math background plus computing background, that's what they have been doing. They have been complete opposite to what other people say. So let me compare and contrast. Buffett says 20 punch rule. In your lifetime, buy only 20 stocks, that's it. Once you have bought the 20th stock, you can't buy a 21st stock. These guys will go in and out of instruments n number of times in a day. Sometimes the holding period could be 1 hour, 1 day, 1 week, or maybe for a split second, who knows. So they have no limitations on the number of instruments they'll deal or the number of times they'll deal. It's extreme high churn. Buffett Munger says no leverage. These guys leverage. Buffett Munger talk about equity shares are a part of owning of a business. These guys will trade any kind of company as long as their formulas tell them that there's money to be made in this trade. So all these are contrasting things. Typically, what we would think about and what these guys do are complete opposites. So we'll see how we can make the two ends meet. So obviously, if it's so different from what traditional investors have been doing, then where is the meeting point? So we'll discuss some of the things in today's talk. So first is trying to understand what they do to a limited extent, and second is what can we learn about quant in general. So while Jim Simons is extremely secretive, or Renaissance Technologies is extremely secretive, all quants are not like that. So in fact, just like CFA, which is a course for learning investing, there's a course, Certificate in Quantitative Finance, CQF, which is a training course on quant. There are practitioners who are very open about their method, or open to a large extent. So there's an organization called AQR, Applied Quantitative Research. They have a website where they publish all sorts of papers on the different quant strategies that they run, or the different factor investing methods that they run. So while we may not know what Renaissance and Jim Simons are doing, but we generally have a feel for what quants are doing in the world. Okay, again, today's talk, I am not the expert on this, so I have learned from many people, and I've put all that together to create today's talk. So for those who are interested, this fellow Parijat Garg has a wonderful webinar on the CFA Institute website, CFA Society India website. So you can look that up, listen to that presentation. The interview was done by Srinivas Kunte, again a office bearer of the CFA Institute. And those of you who are charter holders can also attend Srinivas Kunte's workshop that he runs for society members on some of these aspects. So these two have written books on the subject. Gregory Zuckerman is the person who wrote the book on Jim Simons. So I've learned from that. Samir Arora is not a quant person, but his presentation was interesting in the sense that first discard all the rules. So that was a wonderful talk given in Delhi. So you can again look it up on the YouTube channel of CFA Society. That's an interesting talk to go through as a primer to first dive into the world of quant. Because many times we are so rigid in our thinking that we discard some of the things out of hand. First is to break all the rigidity. So Samir Arora's talk was good in terms of breaking rigidity. And Rishi Gosalia, we have spoken about him in the past, but it was interesting chatting with him in terms of generally what's happening in the world of AI and ML and things like that. But again, this is only a partial list. There are many, many more people I have spoken with, many papers I have read or books I have read. So some of them I may have forgotten. So it's not a complete list. So this is the webinar that I was talking about, Parijat Garg with Srinivas Kunte. This is the title, Algorithmic Trading, an Introduction to the Nuts and Bolts. Okay, so what we are saying is, let's talk about the new world where computers will play a bigger role in terms of investing. No matter what you are doing, no matter whether you are a short-term trader, algorithmic trader, high-frequency trader, or whether you are a long-term investor, given the huge advances in computers, I think it would be a severe disadvantage if you did not choose to use computers going forward. So a lot of people look at Buffett and Munger and say that, oh, Buffett does not have a computer on his desk, Munger probably does not even know how to use one, and people say that that is worth emulating. I don't think that is necessarily the case. If you read Buffett's biography, initial years he would go through value line, the printed manuals, the printed statistical books on different companies. He would go line by line. Today, an investor would just run a screener. Give me all companies with ROE higher than this, or with debt equity less than this, or whatever criteria you want. The screener will give you that output. Why would you want to take a printed value line and go line by line, or just go through numerous pages? Same way, the way things are going into the future, using just a screener or just a Excel spreadsheet may not be enough. You may need to use some of these tools to really up the game, to really get better at what you are doing currently. So we'll look at some of the ways that we could use these tools in our lives. Yeah, so this was again the title of the talk in the CFA Society. So people who are interested can look this up. Before diving into the future, first discard rigidities in your mind. So if you say high churn is bad, first you should define why high churn is bad. High churn is bad because you incur brokerage, you incur transaction costs, impact cost, STT, capital gains tax, and it could be a sign of overconfidence bias. It's bad because of these maybe 3 or 4 things. But if there's a clear mathematical proof that by incurring this churn, it will be financially beneficial to you, you should obviously discard that anti-churn bias and do the transaction. So for example, if you are a mutual fund, or if you are a offshore hedge fund dealing in US, for example, and if you are not going to incur transaction taxes, and if there's a 0.5% benefit by churning, why would you not churn? Because that's free money. And mind you, 0.5% per day if you are getting, then in 200 trading days, it's 100% return. So if you want to go further into the quant world, or if you want to learn about some of these techniques, at least initially leave your biases behind. Later on, you may stick with them if you want. But otherwise, the mental block will be so high that you will not even go further. So as again, Deng Xiaoping, the reformer of China, said, it does not matter if the cat is black or white, as long as it catches mice. And the context for this was that China for many, many decades was completely in the path of communism. And Deng Xiaoping said, I want to do what is good for the country. If it means that I'll take elements of capitalism and improve economic well-being, so be it. I will not be rigid in terms of my ideology, or say that this is what Mao said and that's why we can't do it. I'll discard that. So same approach one has to take. Yeah, so don't get into, I am a investor who does concentration, or I am someone who does diversification, low churn, high churn, or that technical analysis is useless, or that trading is useless, or that one should never leverage, or derivatives are weapons of mass destruction, or 20 punch rule, or I only invest for 5 years plus. First, keep this aside, all of this, and then go forward. The first way in which you can use computers is that whatever you are doing currently, you can do it at a quicker pace and in large volume. A cashier could dispense only so many notes or do so many transactions in a day, and at the end of the working hour, cashier would go home. The ATM machine does the same work at more efficiency, right? So person doing manual totals versus person doing computerized accounting. Obviously, computerized accounting is much faster, much more scalable. So first thing that computers do is enable you to scale. Let us say you are currently a value investor looking at high return on equity companies with low debt and available at a reasonable dividend yield only in India. With computers, you could scan for similar companies the world over. So the limitations that humans have, that they will work only 8 hours in a day, in that they'll take lunch breaks, coffee breaks, siesta, WhatsApp, Facebook, all of that. Computers don't have any such limitation. They don't fall ill, they don't have to take a vacation, they don't have domestic fights, they don't have any of the problems of human beings. So you can scale, you can go through numerous exchange filings in an automated manner. These days, you can pull data from the web rather than humans going to different websites, copying that number, inputting into a spreadsheet. All of those things can be automated these days. So this is one aspect in which computers can be beneficial in our investing. The other low-hanging fruits are that whenever you have computers scanning through millions of data points in terms of prices coming in, let us say you own a stock and it's your core long-term portfolio. But if there's a 5% price difference between BSE and NSE, or if there's a 10% discount in the futures contract of the stock, now machines can identify these things automatically and bringing it before you. And if you are adventurous, you can even put that trading decision into the computer and it will trade on your behalf. So some of these things are possible. Also, you can use some of these signals to better execute your longer term trades. So whether you are buying or whether you are selling, and this is not high churn, even your core fundamental buying decision, it can execute better for you. Again, I'll take one concept from Parijat Garg's presentation, webinar. He gave a very nice definition of algorithmic trading or investing or whatever you want to call it. He says 3 things have to be there for any process to be called algorithmic. First, it has to be objective. You have to quantify. You cannot say this is a great management, this is a terrible management. You have to quantify stuff. You have to have rules. So it should be rule based, saying that this is the rule. If this happens, then this will happen. If this happens, then this will happen. And finally, based on those quantitative and rule based criteria, it should give you a decision. Should you buy this company? Should you hold this company? Or should you sell this company? Or currency or commodity or what have you, bond. So one thing we can learn from quants and from algo traders and all is how to make our investment process more objective and more rule based. Most value investors or most investors in the Buffett mold make statements like this. Oh, I invest in this company because it's a great management. This cannot be objective or rule based. Probably we need to break this statement down further. What is great management? It should be honest. It should be competent. It should be frugal. It should be a great capital allocator. Whatever parameters that you put in, first identify those parameters. Then say, how will you judge the company on these parameters? So, competency of a management. Are you defining competency by ability to increase market share? If that is there, then objectively identify. Has this company increased market share over the past 10 decades? If the answer is yes, it is competent. If the answer is no, it is not competent. So whatever right now we are doing on a subjective basis, try and do that more on an objective basis. Because unless you are objective, the computer will not be able to work for you. Computer is a dumb machine. It has to be told with precision what is it that you want. Once you tell the computer something with precision, it will able to do work for you. Again, make the investment process rule based. So some of you may have read this book, the book that beats the market, or the little book that still beats the market. Joel Greenblatt, Magic Formula. So he had a simple rule: rank companies based on their quality in terms of return on capital employed or return on equity or whatever parameters he uses. Rank the companies on cheapness in terms of how expensive the company is. So the cheapest company comes to the top and the most high quality comes to the top. And then have a joint ranking. So if you are number 1 in quality and number 5 in cheapness, then your joint rank is 6, 1 plus 5. Then come out with a combined ranking. Invest in the top 30 or top 50 companies. After 1 year, start afresh. Some would have worked, some would not have worked. That's it. And by doing this simple rule-based thing, he says, over the years, you can easily beat the indices. So this is one rule-based approach, which could be classified as a quant approach. So quant approach is make your process more objective, make your process more rule-based. The other way that increasingly computers can help us out is in researching some of the parameters that we want. So famously, American Express had this big scandal, the salad oil scandal, where their core business was payments, the traveler's checks and things like that. And the other business was warehousing, and stupidly they had gone into an unrelated business. And there was a big scandal in the warehousing business called the salad oil scandal. So Buffett saw the stock price collapse because of that warehousing scandal, and he had a decision to make. After the scandal, will the payments business survive and thrive? So what he did, he went to various restaurants or various merchants and figured out whether they are still accepting American Express as a payment mechanism, whether customers are still using it and all that. He did legwork, he did ground research, which is called scuttlebutt, which was a term used by Philip Fisher in his book. Now this was scuttlebutt of an earlier era. Finally, as an individual, how many outlets can you go to? You can go to 5, 10, 15, 20. Is there a way computers can do things better for us? Let us think about it. Let us say you want to predict when the auto slump will end currently, or if you want to predict how are car sales going to move in the month of November or in the month of December 2019 as compared to the previous months, what can you do? So just as a thought experiment, don't take it too seriously, but let's look at this noisy graph. If you do a Google search for Google Trends India, you will come to this page. And in that you can search for any term that you want. Now look at this. They scale searches for a particular term on the basis of 0 to 100 in terms of the trends. So 0 is lowest level of interest, 100 is the highest level of interest for that term across its own history. So look at the period around early 2016. The search term the search volume was close to 100 here. Look at the period around December, Jan 2017. 50% of the peak volume. This is 50. This line is 50. So when search volume for car registration is falling by half, it means that fewer people are buying cars because which they want to get registered. Could be an indicator of where things are moving. And when interest rises, temporary. This could be maybe the Diwali period, the festive season where people would have been searching for registering new cars. Again, there was a sharp dip to sub 75, and again it seems to have picked up. Now, whether this is true or not, we'll get to know in the future, but this is just one indicator. So there's a famous example that an app called Foursquare, where people would check in which restaurant they are or where they are, could predict sales of a restaurant like Chipotle many months in advance, saying that their sales are going to go down. So today there are various different methods by which you can use different kinds of data or what is called alternative data to identify trends early. So this Google Trends, not only you can search for one parameter, if you want to know whether Ertiga is doing better or Creta is doing better or Seltos is doing better or that MG Rover's MG car is doing better, you could search for comparative things and you will see various graphs which will show you shifts in market shares and shifts in trends. So again, there is an interesting story about how data can be used to profit, and this story goes back many, many years. So the Rothschild family, the rich European family, had this Baron Rothschild, and story is told about Baron Rothschild that he had carrier pigeons to you tie a message to the pigeon's leg and it will fly to whatever predetermined destination. So it is said that he used carrier pigeons to find out that British soldiers had defeated Napoleon, and he went out and bought British government bonds because they would appreciate in value now that the war was over. Now, the story may be true or may not be true, but it indicates that if you know in advance something that is going to happen down the road, there are plenty of profitable opportunities. Now, let us say you are the IT manager in Flipkart or in Amazon, India. If you see people searching for one brand of toothpaste more as compared to the other, or if you see that, let's say, Coca-Cola's sales are falling and paper boat sales are rising, then you have an information opportunity. Now, whether your organization allows you to use that information or not, whether it's legal or not is a separate matter, but whatever is publicly available, you can find out. So again, instead of going to Amazon's site every day to figure out the price of some soap, you could write a computer program which could do it for you. It will give you the price trend of some product on a website. So all these things are possible with increasing use of computers. This is what quants are doing these days. So people take satellite photographs of parking lots. So if you take photograph of a Walmart parking lot every day and you create a trend, you can figure out last Christmas the parking lot was 100% full. This Christmas it's full only to the extent of 80%. So I expect Walmart sales to fall by 20%. You could arrive at some kind of data like that. There are people who are providing satellite photographs of container ships moving or of metal mines in terms of how much output is there, how much stock is there, all those kind of things. In fact, there are data vendors who provide this for a price to all the hedge funds and to all the quant guys. You could write a program to scan through all Twitter, Facebook, LinkedIn, Glassdoor, Naukri.com posts to figure out whether people are talking good about this company or whether people are talking bad about this company. So ICICI Bank, there was this big controversy, right? Where the CEO was asked to go and an investigation was launched against her. There was a blog post alleging this almost 1 or 2 years before that. So it's just that people had not read that or had not figured out the existence of such a blog post. So today tools are available to scan through the entire web, condense the uh, information in a relevant manner. So again, you don't have to spend your entire day on Twitter to figure out. The program will do it for you and give you the gist that, uh, let's say, Apple launches a new iPhone. How do you know whether it's going to be a hit or not? You can write a program comparing the Twitter sentiment for iPhone 11 versus iPhone 10, and the computer will give you a result. People were far more positive on iPhone 10 versus iPhone 11. That's a data point. In fact, you could probably guess sales even before uh, Tim Cook, probably, if you use some of these tools better. And this is not inside information. This is your own research from alternative data. Another thing that quants do very, very well is they, given that most of them are mathematicians and computer programmers, they don't have sentiment and stuff like that. They say, okay, this is your hypothesis. Is it borne out by the fact? Everything they need evidence. And unless evidence backs you up, they will not execute a strategy. Or if a strategy was working in the past and it's not working anymore, they will stop using it because evidence tells them to stop using it. This was the most interesting part in the book on Jim Simons. The people who have made this 60% return, and they have been doing it successfully in equities also, or they've done in commodities and currencies and stuff like that, they have no understanding of what they are trading. So if they are trading currencies, they have no understanding of differential interest rates, uh, differential inflation, fiscal deficit, capital flows, none of it. They are just able to extract data, put computing power to work, and get trading signals, figure out that price will move like this. So which actually is a bit frustrating. We learn all this finance theory and all that, and these people just put raw computing power to work and generate far higher returns. But one learning from this is, don't be too fixated on preconceived notions. Do what works. So Taleb again talks about it in all of his books, saying that typically academics and science comes later. First, the body of knowledge builds in terms of how to do things. So the earliest people who built wheels, figured out by trial and error that round wheels are better in putting on a cart rather than square wheels. Square wheels result in very bumpy rides. Now, they had no theory of physics or gravity or anything like that. They just by tools and by craft figured that out. Same way, a lot of investors, traders, quant guys, on a practical basis, see that this trend seems to be working. Why that happens, sometimes they cannot explain. So, for example, one of the uh, things in the book, they said that if in the last half an hour or last 1 hour of trade on a Friday, if the price moves up significantly of anything, commodity, stock, currency, the chances of that trend following on Monday are very, very high. So they observed this based on past data and they used it in their actual trading strategies. Now, why does this happen? They don't have a very coherent answer for this. They again had this observation of a pair of related uh, trading symbols. Let's say ICICI Bank and Axis Bank typically trade in tandem. They saw that if on one particular day price of one moves in the opposite direction, and that is accompanied by increase in bid ask spread or increase in impact cost, that trend will reverse out the next trading day. So they hypothesize that it's because of one large buyer or seller impacting the price of one of those two pairs. So they would enter into an offsetting trade, and most of the time it would make money for them. So they don't have coherent explanations. They don't have fancy theories for this as to why this should happen. They just know that it happens. Just like this Joel Greenblatt's formula. Now, instead of even trying to find out rational reasons, Joel Greenblatt says that this works. Now, if you believe him, you can go and apply the strategy. Don't try to overthink it in terms of why this happens or why it should not happen and things like that. So in trading, there are two kinds of things or two kinds of strategies that people use. And the reason why most traders don't make too much money or lose a lot of money is that they fall in one of the two categories. Either they are trend followers or momentum chasers. That is, if prices are going up, they think it will keep going up. And if prices are going down, they think it will keep going down. Or there are other people who try and bet on mean reversion, saying this is overbought, I think it will come down, or this is oversold, I think this will bounce up. Those are the people who bet on mean reversion. And it works sometimes, it does not work sometimes. What these guys seem to have cracked is trying to figure out when momentum is to be applied and when mean reversion to be applied. So how they did it, I don't know, but there is allusion to the fact that they mix both the two strategies. By far, the most interesting thing in the book that I found, and I find it very, very difficult to believe, I think the statistic is wrong, is that somewhere in the book it is mentioned that this Medallion Fund, which has made 66% annual returns, has a success rate of only 50.75%. They make money only on 50.75% of the trades. They lose money on 49.25% of the trades, roughly. So what they are saying is that they act like the house in a casino. The odds in their favor are tiny. But the fact that they bet small and they make so many number of bets that on an average, they earn huge amount of money overall. So sometimes for fun, when I am going through social media posts, people make fun of Warren Buffett. Oh, that fellow lost so much money in Kraft Heinz. What an idiot he is. Or Rakesh Jhunjhunwala lost money on Dewan Housing. What an idiot that person is. Or any famous investor, they'll pick on Prashant Jain, they'll pick on Naren, they'll pick on Motilal Oswal, they'll pick on us or whoever. People find pleasure in other person's misery, but actually it's not even misery. The nature of investing and nature of trading is that you will not get 100% success rate. Successful investors and successful traders are people who know how to calibrate their weightages in terms of different positions, are people who know how to exit when things go against them, and who on a portfolio basis or on an overall basis earn decent returns. Never expect any investor or any trader to go 100% right in all their investments. This is a classic rookie mistake, and people who make fun of such things are actually to be pitied upon because they don't even know what investing or what trading is all about. And that is very clearly demonstrated in this book. How you can be enormously successful on a portfolio basis, but a number of your trades or a number of your investments can go against you. So you should play this. If you have this kind of an opportunity, you should play this again and again and again, because you may lose on some of the bets, but as long as you are not putting all your capital on one bet, and as long as you have the capacity of playing this kind of a game for tens of thousands of times, ultimately you will end up winning, because your winning probability is 55 and your losing probability is 45. You are like the house, or you are like the casino, where people individually could win against the casino, but as a group, they end up losing against the casino. And don't obsess over individual wins and losses. So the risk management, portfolio approach, how much to weigh each position, all these things are very, very important. This was the other interesting aspect. So one of the reasons why probably this person is not richer than Bill Gates and Jeff Bezos and others is that, and the other reason why he's very secretive is that the organization, which is Renaissance Technologies, they believe that they can only handle a certain size of money. If the size increases, they will not be able to earn these kind of returns. So what they do, especially in recent years, all the profits of a particular year, they've been paying out. They don't compound it. So it's not that you started with 100, if you had 66% return, next year you will start with a base of 166. They will most likely pay out 66 and just retain 100. Another thing is that reason for secrecy is as more and more people start copying your strategy, the returns come down because those inefficiencies go away. So I remember in 2007, cash to futures arbitrage was a very, very lucrative trade in Mumbai. So we were generating returns like 18%, 20% per annum, and in a more or less risk-free manner. And there were professional pair traders who were generating 30% plus. But the moment more money entered and the more and it became computerized with co-location in NSE and with algo trading, today the returns have fallen to 5, 6, 7%. So nothing spectacular, 5.5. It gives something like money market returns these days. So as more and more people get to know about your strategies or some of the inefficiencies in the market, so like this Friday trend continuing on Monday, as more and more people came to know about it, that strategy stopped working or was not that effective going forward. Yeah, so this is in short a brief description of what this interesting book was and what are some of the learnings that we can have. There are some caveats to this. Firstly, this company itself has had big successes in commodities, currencies, and bonds. Their success in the initial years was very, very limited in equities. They were usually getting it wrong in equities. It's only in the last few years that they have become more successful in equities. So equities is a tough asset class to crack using just quant tools. The second is that quant works relatively better in terms of giving you short-term trading signals. So if you analyze Google Trends or Twitter sentiment, it will tell you what this month's sales will be or what next month's sales will be. It will not tell you 5 years out whether electric vehicles will be a bigger share or whether petrol vehicles will be a bigger share in the marketplace. That research you have to do elsewhere. So quant tools work well in the short to medium term, not so much in the long term. And sometimes when you try to use these too frequently, sometimes they may misguide you also. So Another thing to note is that there are various signals that could be there. So for example, I gave the example of satellite images of parking lots. Now that could be one signal. Maybe it's correct, maybe it's misleading. But if you combine it with multiple signals, let us say parking lot occupancy is just 80%. Let us say Twitter sentiment is extremely negative for Walmart. Let us say insiders are selling shares. If all these signals combine, then you are sure that something is wrong. But if one signal is positive, one signal is negative, so if satellite images say parking lot is only 80% full, but if the CEO, CFO, some senior management are aggressively buying stock in the market, then you don't know what to do. Is it a positive signal? Is it a negative signal? So sometimes there may be conflicting signals. So it's useful only if multiple signals combine in one direction. And again, as more and more people start doing it, your advantage goes away. So carrier pigeon had an advantage before telegraph was invented. Once telegraph was invented, advantage of carrier pigeon went away. So that's all for today. So given that we have more centers, we'll try and have short questions and we'll cover as many questions as we can. Yeah, we'll start in Mumbai, then go across to Pune, Delhi, and Bangalore.
Hi. Given the Rajiv bhai we know, how difficult or easy it was for you to get prepared for such type of topic?
It was not a one day kind of thing. And so I've been reading about this, thinking about this for maybe a year now on different aspects of this. And it's still work in progress. So it's not complete in that sense. What we are trying to do is we are trying to develop our own research process in such a manner that a lot of the things that we do manually right now, we can automate and we can cover more number of companies. So the objective is not to become another Renaissance Technologies or discard the learnings of value investing. It's just how to use some of these additional data points or some of these additional tools better in our research.
Thank you, Rajiv bhai.
Thanks.
Rajiv, given that India is a market which is like really unorganized side, and so actually getting data points like this and relying on those data points in India is probably still how many years away in your opinion?
So the thing is, let me elaborate this by a funny story or a joke rather. Let's say you, I, and Ronak are in a forest and we see a lion. We have to start running, right? We have to go away from the lion. But we don't need to run faster than the lion. We have to run faster than the other two, right? That's all that we need to do. So, in a market with internet and fiber optics, a telegraph is slow, but telegraph is faster than carrier pigeon. So, in any market, even an inefficient market, all you have to do is be more efficient than the rest of the competition. So, the data points may not be as many as in a developed country, but still you can do something to better the existing process. That is one part. The second part is government of India is increasingly moving towards open data. So there is data.gov.in, right? Data.gov.in. Just go to that website. You can directly import that data into Excel. So all different ministry data, and it's not great right now, but they are improving on it, and they are trying to put a lot of this stuff out there. So it's not that India is lagging very, very far behind.
Rajiv bhai, great talk. Couple of very interesting points that we were discussing that you mentioned. It seems to be a little bit more towards the institutional bent that would be able to really capitalize on this because of the skill involved from a mathematical standpoint, B, an IT standpoint, and C, the ability to have a lot of capital to employ in one of these strategies that you were to find. So, to a retail audience, how would you advise us to think about search costs, which is basically the time employed in kind of finding this, and also in terms of scalability, in terms of capital available to a retail individual to be able to put into one of these strategies? How would you look at that trade-off, the search cost versus ability to deploy capital?
There are tools and there are tools. So the example I gave of Google Trends, for example, is available to anyone and everyone. Some of these tools, like this Twitter sentiment analysis, can be created for free. You don't need, in fact, a lot of the entire field of machine learning and stuff, the people doing work in that space are fanatics about open source. So all the softwares are free, and all the codes that they write, they put on websites like GitHub and all that. So there is a learning curve involved. So unless you are willing to put time and effort in terms of learning some of these tools, it may not work. But capital cost and computing resources is no longer a barrier. So just that's an interesting question. So when Renaissance technologies started out in the 80s and 90s, that time they bought all these servers, they were taking all this data on magnetic tapes and whatnot. But these days with cloud computing, where you just pull out a credit card and you can get a server for hire and do some of this stuff, or open software and open libraries, it's not so much of a problem of resources, it's a problem of time, effort, inclination, things like that. And yeah, you are right. So institutions will have more people to throw at this project, and they can do it in a more organized manner. But part of the interesting thing is first coming out with a concept, that thinking about that this is a data point which I could possibly use to predict this, on which there's no monopoly. So there's no monopoly on ideas and thinking. Maybe a retailer can come up with something interesting.
Thank you.
Yeah, we can take questions from Pune now.
Yeah.
Yeah, no questions from Pune.
Yeah. Alok, we are done. No questions from Pune. Bangalore, Nijit.
Hi, Rajiv.
Hi.
My question, Rajiv, is that what percentage of the trades at this point in India happen in using HFTs or whatever? The other part is that there is a very interesting talk by Andrew Lowe in MIT Financial Engineering One, where
Yes.
he tells that you shouldn't get carried away by data, and he was talking about the data for the financial crisis that happened because all the data that was there was of an uptrend and there was no downtrend, so people predicted that it'll always be there. And obviously there was some percentage of the trades at this point in India happen in using HFTs or whatever. The other part is that there is a very interesting talk by Andrew.
Yeah, that's a wonderful question.
Get carried away by data, and he was talking about the data for the financial crisis that happened because all the data that was there was of an uptrend. There was no downtrend, so people predicted that it'll always be there. And obviously there was some.
Yeah, wonderful question and wonderful points. So I missed out on some of these points in the talk. In 2007, and this is far before the financial crisis really came to fore in 2008. Somewhere in middle of 2007, there was something called a quant quake, as they refer to it. All quant funds were losing enormous amount of money. So although the annual returns of Medallion Fund look very, very smooth, intra-year journey somehow has been very scary. So there were a few months where nothing seemed to be working even for medallion fund and they were losing a lot of money. And the point that is being made is that a lot of these strategies rely on past data. So anyone who backtested past data up till 2007 would not have predicted what happened in 2008. So a lot of people lost enormous amount of money in 2008 using a lot of these math stat kind of strategies. So let me be very clear upfront that Medallion Fund and Renaissance Technologies are the exception. They are not the rule. So all quant funds are not as successful. So just like all value investors are not Warren Buffett, same way all quant fund houses are not Medallion. A lot of them earn mediocre returns or just about average or better than average. And some of them even lose money spectacularly. Also, these past data and trends and strategies are not guaranteed to work all the time. So you have to keep testing and retesting it, and also keep your risk parameters under control. So you have to upfront figure out what will be impact on you if things do not go your way. Another interesting question was what percentage of overall trades are accounted for by high frequency traders, algo traders, and all of that. I don't have an exact number. It's a very high proportion increasingly. So a rough number that I had come across was somewhere between 30 to 50% of the trades, depending on different markets and different time periods. Yeah. Okay. We can go to Delhi. Ninad?
No more questions from Bangalore.
Yeah. Ninad, you can go ahead from Delhi.
Am I audible?
Yes.
Namaskar, Rajiv ji. I'm Amit Gupta. Am I audible to you?
Yes, please go ahead.
Thank you. Rajiv ji, it is always a pleasure to learn from your insight, especially last time your colleague discussed about aerospace industry. It was really eye-opener for us. I just wish to understand, have you ever tried sharing the topic of the next FOF so that the audience can come little prepared?
We have tried in the past. The experience has been mixed about that. Almost no one prepares for the topic. So probably all that they prepare is they decide how many cups of coffee they'll need before coming to the talk. And what happens is many a times people prejudge saying, oh, this topic is interesting, this topic is not interesting. So today's talk, if I had described it in one line, one word or in one sentence, it would be difficult for people to understand what I'm really going to talk about. So it's always better to have that element of surprise. That's been our experience based on past FOF sessions where we had disclosed the topic in advance and not disclosed the topic in advance. The experience of not disclosing has been better so far. So evidence-based, quant-based approach.
Great. Thank you so much.
Thanks.
All right. Thank you.
No more questions from Delhi.
Great. Thank you everyone for joining in and hope to see you in December. Bye-bye.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs. Glorious eyes. And sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.